What's the difference between different types of entities? I mean, what makes a sole proprietorship different than a partnership, or a partnership different than a corporation? Well, it makes a big difference in a lot of things when it comes to your liability as well as your ability to be able to get credit and financing for your business. And in this training, we're going to talk about the difference between business entities and all the information you need to know to choose the right entity for your business. We're going to talk about which entities are looked at very negatively by lenders and credit issuers and must be avoided at all costs. We're going to talk about the top entity type that you want to choose that lenders and credit issuers love and that show that you are a really fundable, credible business. We're going to talk about other nuances of entities that a lot of people do not know about. We're going to talk about all the things you need to take into account when choosing the right type of entity, and we even talk about the ability to choose entity types if you got this wrong. And if you stick around to the end of this training, I'm going to get you access to our step-by-step business credit building guide, which even has even more information on other aspects of fundability you're going to want to know to get maximum funding for your business. We've got a lot to cover, so let's dive in. So per the IRS, there's really three main types of business entities. First, we look at being a sole proprietorship. We also have partnerships, and we also have corporations. Now, you're obviously familiar with LLCs as well, but they're not seen as an official entity type per the IRS. But don't worry, we're going to talk about LLCs as well. So let's get started by talking about sole proprietorship. So a sole proprietorship, you and the business are one and the same. As a matter of fact, if you don't choose a DBA, really your name is the business name in a sole proprietorship. So a lot of problems here, and definitely an entity type that you want to avoid at all costs. First of all, sole proprietorships aren't really seen as real serious business entities by anybody in the credit financial space, even SBA themselves. SBA refers to a sole proprietorship as basically a business owner or entrepreneur experimenting with a business concept. So that's how negatively it's looked at, is that SBA even says, well, this is somebody testing a concept, not even a real business. And exactly seen the same way with lenders and credit issuers, that they see that you're a sole proprietorship. In a lot of cases, you're automatically going to get denied. A lot of lenders and credit issuers will not lend, they will not issue credit to a sole proprietor because they just don't see you as really having an official, legitimate business. The other thing about sole proprietors that you want to know is if you're a sole proprietor, then that means that you're covering all the taxes, the expenses for the actual business. So you and the business are one and the same. The business isn't paying its own taxes, you're paying the taxes as well. And the other thing to keep in mind is you are the business. So you are 100% liable for what happens in that business. Now, don't get me wrong. I'm not an accountant and I'm not an attorney, and this isn't legal or accounting advice. As a matter of fact, it might make sense for you to talk to an attorney or talk to an actual accountant for that kind of advice. But you need to know that being a sole proprietorship, you are the business. So if anybody comes after the business, well, they're suing you as well. There's really no layer of protection to prevent that. So a lot of reasons you want to avoid being a sole proprietorship. It's way harder to get access to credit and financing. You are liable for what happens in the business, and it's not the best choice for tax purposes either. So this is definitely the one you want to make sure that you avoid. Now, let's talk a little bit more about partnerships. Partnerships aren't necessarily frowned on by lenders and credit issuers, but they're not looked at as the most highly regarded entity type either. And we'll talk about what to choose here in a few minutes. So partner entity types, are some things you should know about. First of all, being a partnership is sometimes necessary. If you're going into business with one or more people, then partnership might be the right entity type to choose. Now, keep in mind that when it comes to paying taxes, partnerships don't pay taxes. The actual taxes that need to be paid, the profit or loss, carry down equally to the actual partner's tax returns on the personal side, and then they actually pay their own share of those taxes. So when we look at a sole proprietorship versus a corporation, for example, we'll talk about corporations later, well, then an individual, the actual profit loss of the business carries over to the individual's taxes instead of the entity itself paying those taxes. Same thing in the partnership realm. So in the partnership realm, the entity isn't paying the taxes. The actual profit, the loss, carries down to the individual owners of that partnership, and then based on whatever split of partnership they have, and then those partners on their tax returns actually are reflecting the profit, the loss, and actually covering the taxes there. Now, when it comes to liability, well, partnerships share in the equal liability of the business. So that means that if you're in a partnership, well, then you're liable not only for your own actions, your own decisions, your own debts that you're accruing, but you're also equally responsible for the decisions, the actions, and the debts accrued by another partner. So some things to keep in mind. And partners' debts can be taken. Your stocks, your bonds, your house, any assets you have can actually be taken to make you responsible for other debts that other partners accrue. So sometimes even more dangerous than a sole proprietorship, because not only are you liable for what you're doing, you're liable for what your partners are doing as well, and you're putting your assets in harm's way. So something to think about. Sometimes, like I said, being an attorney, if you have partners, being a doctor, if you're going into a practice there, sometimes you can't avoid partnerships. But you have to keep in mind, you must really be aware of who you're choosing as a partner, because not only are you taking on a lot of responsibilities for the debts that they may accrue, but also decisions and actions they take on can carry down to you as well. So some things to consider if choosing a partnership. Again, sole proprietorship, definitely want to avoid. Partnership, not looked at really favorably by lenders and credit issuers, and definitely some traps you may fall into with that entity type, but still way better than a sole proprietorship. Now, let's talk about the next type of entity, corporations. A corporation is seen as the most highly regarded entity type you can choose when it comes to a lender or credit issuer's perspective. Look, they love corporations. And just because of the fact that you are a corporation goes a long way to helping you become very fundable and helping you get the most money at the best terms. So you really, if you can choose a corporation. It's what gives you the most credibility. Now, there's two types of corporations you can really choose from. There's an S Corp or a C Corp. Well, there's others as well, but we'll talk about the main types that you really want to look at. So an S corporation really has to do with the profit or loss of the business carrying over to your personal taxes. So that means if the business makes a profit, well, that profit carries over to your personal taxes, and you will pay taxes on the personal level for the profit of that business. Now, on a C corporation side, the business pays its own taxes, and then it pays you, and you pay taxes on that income. As a matter of fact, this is why a lot of business owners don't usually start as a C corporation, because a lot of accounting professions see this as you being double taxed. And what I mean by that is the actual entity comes in, and let's say the corporation makes a profit. Well, the corporation pays taxes on that profit. And usually the tax rate is higher on that level than you would on the personal side. Then the corporation pays you, and then you pay income taxes on what you get paid. So you have to pay typically more taxes with a C corporation, which is why most business owners don't start this way. But typically, as a business grows into a 7 or 8 figure business, you really want to potentially choose to be a C corporation, because at that point, you might not want the profit or loss from a $7 million company or a $1 million or a $20 million company carrying over to your personal taxes. Again, it makes sense to talk to a tax professional, to talk to an accountant as well. This isn't legal or accounting advice, but from a lending perspective, choosing a corporation is the best way to go. Whether it be S Corp or C Corp, doesn't matter from a lender's perception. That really has to do more with how you want to pay taxes. Now, when it comes to liability, a corporation is also your best bet, because what happens is you and the business are separate from each other, and your personal assets have a layer of protection there. So that means that if the business gets sued, if the business defaults on its debt, there's a layer of protection there for you where your personal assets are somewhat protected, in large part protected because they're separate from the actual business. So from a corporation standpoint, it's looked at as the most highly regarded industry from lenders and credit issuers perspective. You have a choice on how your taxes are actually paid, and it also reduces your liability and creates a layer of protection. So if you can, a corporation is definitely the entity type you want to choose. It gives you the most protection and gives you also the best perception from lenders and credit issuers, helping you get the most amount of money at the best terms. But LLCs are still out there. What about LLCs? Let's talk LLCs. An LLC is also looked at as highly regarded by lenders and credit issuers. So again, if you choose another entity type, you might want to layer it with an LLC. It can provide you a better perception from lenders and credit issuers. Now, as I mentioned in the beginning of this training, an LLC is not seen as an official entity type per the IRS. As a matter of fact, if I go to set up an LLC, it's going to ask me what entity type I want to choose. So for example, if I set up LLC in Montana, one of the first questions in the checkout process is, what entity type do I want? Do I want an S Corp? Do I want a C Corp with an LLC there? And an LLC will give you some limit of protection as well. It's called limited liability for a reason, but it does offer you some kind of asset protection. It's a layer of protection between you and the business. So by going with an LLC, then it makes it easier for your personal assets to be protected because the business is responsible for its debts. The business is responsible for its actions. You're not. So it does give you limited protection and make it easier for your personal assets to be protected in case your business ever defaults on its debts, or again, if it's ever pursued legally. So LLC, seen credibly by lenders and credit issuers. And also, because there's another entity type, you choose the tax control that you have there, how you actually want to pay taxes, business or personal. And the other nice thing about LLCs is, again, you're protecting your personal assets. So another good way to go if you don't actually choose a corporation, an LLC can help you get a lot of the same similar benefits, and again, make it easier to get credit and financing from the actual financing system. And there you have it. That's the different entity types and what you need to know about each entity type. Now you know what type to choose, or have some guidance on which type to choose to be able to control those three areas: the perception that lenders and credit issuers have, how taxes are handled, and liability. And again, don't forget, you want to probably talk to an attorney, talk to an accountant, and get their perspective of which ones might be the best. But definitely, without a doubt, from a lender and credit issuer's perspective, a corporation gives you the most credibility. Just by choosing that entity type, it's easier for you to get maximum funding at the best financing terms. Want to learn more about fundability? Entity type is only one of 125 factors that control your fundability. So if you want to learn more, grab our free business credit building guide at creditsuite.com/EIN. That's creditsuite.com/EIN. That gets you access to a step-by-step business credit building guide and even more training on setting up your business where it's fundable. Also, if you got value from this training, make sure you like and subscribe. And don't forget, you actually are entitled to a free consultation with us where we do a fundability assessment to give you advice on what to fix regarding fundability. We get your business credit reports with Dun & Bradstreet Equifax Experience for free, saving you $250. We give you tips and tactics to improve your business credit, and we do a funding assessment to figure out all the funding you can qualify for right now. So if you're interested in your free consultation, give us a call at 877-600-2487. That's 877-600-2487. You can also email us at info@creditsuite.com or schedule your consultation online at creditsuite.com/consult. So hopefully you got value from this training. Make sure you like and subscribe, and keep your eye out on our next training where we talk about more cool ways to get money to start and grow your business.